Welcome to today's webinar, and thank you for joining us. My name is Forrest Bell, Senior Investment Advisor and Head of Financial Planning at Bell Investment Advisors. I have here in the room my colleague, Laurent Harrison, Investment Advisor and fellow member of the Financial Planning team. Today's webinar topic is Financial Planning for Boomers. Before we start, Laurent, can you cover a few housekeeping items?
Sure. Thanks, Forrest. If you're having technical difficulties, please call our office at 1-800-700-0089, or you may submit a request for assistance via the questions box on your GoToMeeting control panel on your computer. If you have questions during the presentation, please submit them via the questions box as well. If we're not able to answer all questions today, we will provide an answer to you via email after the presentation is over. In addition, this presentation today is the second in a series on financial planning for boomers we're doing this year. We presented the first in this series in January. Forrest will be reviewing a summary of the key points of that presentation next.
Thanks, Laurent. As we discussed in our first webinar of financial planning for boomers, boomers are pretty ambitious about retirement. As soon as they secure their own retirement goals, they turn their attention to others, and that attention can take a few different forms. It can take the form of helping their own parents or providing educational assistance for their children or their grandchildren, helping their children make a down payment on a home, on their first home, or charitable giving. Adding goals like these require more financial flexibility from their financial plan. And so to respond to this need, we created the following list that we presented in January. This is a list of financial planning strategies that our boomer clients successfully implemented to create more financial flexibility for themselves. Maximizing cash reserves. There's still a lot of idle cash on the sidelines, and there's a way to be conservative but more productive than a money market with excess reserves. Get an insurance review. As your circumstances change, your insurance coverage should change along with it. Maximize your 401k plan. There are parts of 401k plans that are efficient and parts that are inefficient, and learning to work with both is the best way to get the most out of your plan. Consider adjusting your living arrangements. Downsizing can really create a lot of financial flexibility, as can extending your career by achieving what we call an elastic career by working in retirement. A lot of people resonated and responded well to this list. So the purpose of today's webinar is to expand it. These are additional ways, other ways to create financial flexibility in your financial plan that we'll discuss today. First, adjust your investment strategy. Adjusting your investment strategy for emotional reasons is generally not a good idea. But as your plan changes because you add a goal or subtract a goal or swap goals, using your financial plan to help you determine what might be a yet better investment strategy is an important exercise. Next, adopt a fluid spending plan. Typically, people approach retirement with the idea that their expenses will be fixed. There are virtues to this approach. It's consistent, it helps people stay disciplined, but by being fluid with spending, by being willing to spend more in some years and less than others, you can add financial flexibility to your plan. Be thoughtful about Social Security. Most people make their Social Security election based on a perceived need for income. There's a better way. Analyze your pension options, not just comparing lump sum to annuity options, but also looking carefully at the spousal options within the annuitized versions of the pensions. These are all important ways that you can create financial flexibility in your plan, and I want to elaborate on the first point by way of example, adjusting your investment strategy. If you attended the first webinar for boomers, you'll recall a scenario like this. A couple currently age 65, retiring now with one grandchild, living expenses around $100,000 per year. We're assuming a very long planning life, and their investment strategy is focused on bonds. They have a 20% allocation to stocks and 80% to bonds. Their expected return is about 5.5%, and they have just shy of $2 million investable assets. We're assuming the historical inflation rate, and we're also assuming that they'll take their Social Security at full retirement age, which for them is age 65. Using these assumptions, we can produce results report. This is probabilistic analysis. It crawls back through market history and randomly recombines return intervals to produce the statistical equivalent of 10,000 trials. This probabilistic analysis takes two forms. The first is the spaghetti graph with all those squiggly gray lines. Every gray line which reaches that broad blue band to the right is one that is successful. That represents a plan fully funding all of its goals. The squiggly gray lines that dive off the page before reaching that broad blue line are ones that are unsuccessful, that fail to fully fund the retirement goal. Another way to make sense of this is to look at the other expression of probabilistic analysis that you'll find in the box to the right. This is a probability of success meter, and it shows us that the odds of success for this plan. In this case, there is a 74% chance that this plan will fully fund all of its goals with the aforementioned assumptions. Let's do something now with this plan that many of our boomer clients elect to do. Let's add a goal to it. In this case, an education goal. 4 years at Stanford, which currently cost per year all in over $50,000. The first goal is the same. We're just adding an education goal to it. And when we add this additional education goal to the plan, the results, as you might expect, change. Now looking at this plan, the probability of success has fallen from low 70s into the 50s. This is not a strong financial plan. The odds are not good that you'll be able to fully fund both of these goals over the life of the plan. And so it begs the question, how do we create financial flexibility within this plan? Well, one exercise to perform is to look at investment strategy. We can use planning software to explore different strategies and different allocations to see which one would support and pivot with this decision to add a goal to the plan best. And sure enough, using the software, we saw that if we shifted the emphasis from bonds to stocks, in other words, if we went from an allocation of 20% stocks and 80% bonds to 70% stocks and 30% bonds, the odds of success are much better. We move back into the low 70% range again. This is not a universal endorsement to become more aggressive. Just as often, a conservative approach can produce better odds of success for a financial plan. But it does show the power of an exercise that when your financial plan changes because you add a goal or subtract one or swap a goal, to let the software work as a guide to help you choose the strategy that improves your odds of success the most. We would still like to see this plan be a little bit stronger, so we'll look to the other strategies that we're going to discuss today to help out. Laurent, could you talk a little bit about fluid spending plans?
Sure, Forrest, thanks. When boomers finally reach their golden years, they face a really tough challenge, not outliving their retirement savings. So another method of increasing financial flexibility is to adopt a fluid retirement spending plan. This is all about creating a sustainable withdrawal rate for your investment portfolio. So a sustainable withdrawal rate is one that allows you to withdraw the right amount from your portfolio each year in order to meet all your retirement goals throughout your lifetime, not solely what you need in the current year to keep your lifestyle intact. So let's first examine some basic questions to answer when planning a regular annual distribution from your investment portfolio. What is your time horizon? When do you start, and how long do you estimate your portfolio distributions need to last? How much money do you need from your portfolio year to year in retirement to sustain your lifestyle? Forrest just covered investment strategy in a much greater detail, but generally, higher risk means higher expected return, lower risk, lower expected returns. So in terms of plan success, sometimes that lower risk strategy offers a higher chance of success. Sometimes it's the higher risk strategy that's necessary. What other retirement income offsets the need to draw from your portfolio? Forrest will be talking about Social Security, and I'll be talking about pension incomes a little bit later. Lastly, do you have a desire to leave money to your heirs or a favorite charity? So generally, after thinking through these important questions, we might settle on a fixed amount you can safely take from your portfolio monthly to meet your retirement needs and, more importantly, keep your portfolio relatively intact for the 2 to 3 decades needed to fund your retirement. So let's take a look real quickly at a spending scenario that might illustrate this point. So let's revisit the couple Forrest spoke about earlier that have a plan, still working towards that 75% number or higher. In this scenario, the couple has a combined Social Security income of $45,000. So they've decided, after looking at their situation, that they need to take $70,000 out per year from their portfolio. So if we take $70,000 and do a very simple calculation and divide it by $1.9 million portfolio, we come up with a 3.7% withdrawal rate. So in general, 3 to 4% withdrawal rates are generally considered sustainable, depending, again, on your investment strategy. However, let's take a look at some research done on sustainable withdrawal rates done in the late 90s. The research has its roots in a paper commonly referred to as the 4% rule. You may have heard of it. It derives its name from a 1998 paper called the Trinity study. So in that study, the rule says if you're able to limit your withdrawals or annual distributions from your investment portfolio to 4% or less, you're basically, it should remain intact for the 3 decades that you need to have portfolio distributions. Let's take a look at a couple of additional points. That 4% rule portfolio needs to have a minimum of 50% in common stock, so that was part of the study. Second, inflation is a factor. If inflation is 3%, for example, and your portfolio expected return is 6%, then in this case, 3% is a safe withdrawal rate, not 4%. So sustainable rates need to be adjusted for inflation. Third, this particular study used a 30-year time horizon. As boomers are retiring earlier and earlier today, a 60-year-old couple or a couple that are both 60 years old has an excellent chance of one of the spouses living longer than 30 years. So although 4% rule is commonly quoted by financial professionals as being a safe withdrawal rate, and it has a high probability that it'll last the full 30 years while taking that 4% distribution, there is new data on this subject. So let's take a look at that briefly. So this newer research shows that additional questions need to be asked, such as, does your plan account for inflation? How about when tax rates increase like they did earlier this year? How about if you're expected to live longer than 30 years? Again, the 4% rule took into account just 30 years in their study. What if you prefer to have a significant portion of your portfolio in lower risk assets, such as bonds or cash versus stocks? Lastly, what happens if you decide to either retire later or retire earlier? So before I pass it back to Forrest to talk about Social Security, I want to leave you with the following last slide and points to consider as you plan your own distributions. So in positive market or above average return years, you can generally withdraw 4% or more from your portfolio. So in some examples, depending again on your age and investment strategy, withdrawal rates of 5, 6, or maybe even 7% may be an option if you have a very strong return year. In those years, you may want to add to your emergency reserves, pay down debt, or even add a financial goal like a vacation or a home upgrade. However, on the other hand, in negative or below average return years, you'll need to be more flexible and withdraw less than that 4% you're used to. While this can be difficult since you're used to a specific monthly amount, try it out. Try not to touch your emergency reserves. Realize that in some cases your debt levels may stay the same or go up, and think about maybe removing a goal or doing with less in that particular year. So this is what we mean by adopting a fluid approach to your retirement spending plan. Rather than taking the same amount every year, every month, try to vary your withdrawal rate and spending and adopt that fluid approach. Now I'd like to turn it back over to Forrest to talk about Social Security.
Thanks, Laurent. Another way to increase financial flexibility within your financial plan is to take a thoughtful approach to Social Security. Most people elect to take their Social Security based on their perception, their perceived need for cash flow. So you might be 62 years old and still working, and suddenly you're eligible for a new source of income. If you feel like it's needed, you might just decide to take it as early as possible and take it age 62. Alternatively, you may elect to take it at your full retirement age, which is between 65 and 67, depending on the year of your birth. A lot of people have the instinct, once their earned income goes away, to replace it as much as possible with Social Security. That seems to make sense. At least that is how people oftentimes respond. Finally, you may perceive that you have no need for additional income, and so your strategy is to wait until age 70 and accrue the highest monthly payout from Social Security. The problem with these approaches is they all overlook something important. First of all, taking Social Security at age 62 subjects your benefit to a discount. It's discounted from what it would be at full retirement age. There are also some tax complications. For example, if you're still working after age 62 and you've elected to take Social Security, those two sources of income, Social Security and your earned income, compete with each other. Every $2 or $3 you earn above a certain threshold subtracts $1 of Social Security benefit. So oftentimes taking at age 62 backfires. Also, taking at full retirement age has its disadvantages that are part of the benefit accrual formula within Social Security. Every year after your full retirement age and up to age 70, you receive an 8% increase in annual benefit by waiting. So taking at full retirement age forces you to forego that benefit. Even taking at age 70 overlooks something important. If you wait until age 70 to take your Social Security benefit, you may have overlooked or waited too long to take advantage of spousal benefits, which are very powerful. So how do you decide on an appropriate approach to Social Security? Well, you run lots and lots of scenarios. Let's take a look at this example. It's a single individual taking their Social Security benefit at age 62. In the first column, you'll see the age, as this is organized, and the monthly benefit that they elect or that they receive, $1,800 per month, amounting to $21,600 per year. In the final column, you see the cumulative benefit. So if you move down to age 63, you'll see the monthly benefit has nudged upward a little bit as a cost of living adjustment. Now it's $1,850, amounting to $22,205 per year. And then the cumulative benefit is the sum of those two first years, so on and so forth. Sometimes when you're running this first scenario and showing it to clients, we get an important question, which is, if my full retirement age is 66, how could I possibly justify waiting? I will have foregone $90,000 of cumulative Social Security benefit by that point. Well, let's take a look at another scenario. In this scenario, this same single individual waits until their full retirement age, or age 66, to take their benefit. And you'll notice right away they don't receive anything from ages 62 to 65, but at 66, their monthly benefit is more. Instead of about $2,000, it's almost $2,700, creating an annual benefit of $32,164, moving upward by cost of living adjustments. When you take these two scenarios and you set them side by side, you can begin to see how we look at Social Security. There in the initial columns, you see the cumulative benefits of taking at 62, and in the last columns, highlighted in yellow, you see the cumulative benefit of taking at 66. By age 75, the richer monthly benefit payouts of waiting until 66 have fully caught up with the option to take at 62. That's what we call the break-even point. And you can start to see another way to look at Social Security, which is it's sort of a life expectancy calculation. Were you to live to age 75 or longer, it really serves you to be patient and wait to elect your benefit. This is a good illustration of how our process works. We run scenario after scenario, exploring every possible way to take Social Security and finding the break-even points over all those scenarios, and using our understanding of life expectancy, choose the scenario that gives you the best odds of success of getting the most out of what you've paid into the system. So how does this analysis affect financial plans? Well, let's return to the plan that we began with at the beginning of our webinar today. This is the couple that's added the education goal. By changing their investment strategy from an emphasis from bonds to stocks, they were able to improve from their 56% probability of success to low 70s. But by optimizing their Social Security benefit, in other words, instead of taking at 65, but using spousal benefits and delaying their own benefits until age 70, we were able to prop this plan up to a 75% probability of success. That is stronger than the first plan we looked at without the education goal, and really speaks to the advantages of looking for ways to create financial flexibility within your financial plan. Laurent, could you speak to us about pension analysis?
Sure. So the last area that we're going to cover today that allows you to create financial flexibility in your retirement years is taking a look very carefully at a pension. So if you're lucky enough to be eligible for a pension, you can think of it as a lifetime annuity or stream of payments for the rest of your life. And really those options should be chosen very carefully. So as financial planners, we're often faced with client questions: which pension options should we choose? So let's go ahead and define what a pension is, what should be covered in a typical pension analysis, and we'll try to give you some recommendations on timing on when that analysis should be completed. So just a brief definition of pension and how they've come about. A pension is a type of retirement plan that's been typically offered by employers. They have been very popular from the 1940s really through the 1980s, and since then they've been phasing out or phased out in preference to the 401k plan. It's probably what you're most familiar with. And really it changes from an employer responsibility for the employer to fund that, changes it over to the employee to fund their retirement plan. Pensions were typically employer sponsored and largely paid for by the employer. And also what's important about pensions is to really look at the firm's health, who that employer is and their ability to pay. If you take a look at history of companies that either fell into bankruptcy or fell out of business, like Enron and United Airlines, it's important to gauge the current and future health of your employer when choosing a pension payout option. So what's typically involved in a pension analysis? Well, as Forrest mentioned earlier on life expectancy calculations with Social Security and how important that is, pension analysis also is a type of life expectancy calculation. If you're going to live a very long and healthy life, that's something we want to look at very carefully in terms of taking the pension payout immediately as a lump sum, or maybe streaming it out in annual payout for the rest of your life. Certainly taking a look at survivor options and survivor benefits is a very important part of pension analysis, and taking a look as well at what type of expected rate of return you might be given in the pension payout options. In addition, something that you may not be aware of, and that's important, is to also take a look at life insurance options, what life insurance you may have today or what you can purchase as part of the pension analysis. So as you can see, pension analysis is not maybe as simple as one would think, and certainly pension analysis, whether you do it yourself or through Bell's financial planning services, it's an important piece of the puzzle as part of your retirement planning. Pension analysis also looks at, again, I talked about stability of paying firm, but also other sources of income you have like Social Security. So when you're getting ready to do a pension analysis and thinking who is actually going to be doing this, be aware that it could be completed by you. Certainly your employer or employer HR department gets involved, and certainly you can ask your advisor, your Bell advisor, or a financial planning person at Bell to take a look at it and help you out with your pension analysis. Before I turn it back over to Forrest to kind of do a summary on the presentation today, I wanted to leave you with some timing guidelines. So many of our boomer clients are asking when should they start reviewing their payout options and their pensions and how they should go about doing it. So we generally recommend 5 to 10 years prior to retirement, request a pension benefit statement from your employer, take a look at a variety of retirement years, a range of retirement years, begin documenting those savings and income, find out if you can buy years of service, and again, consider completing a pension analysis. When you really get to much closer to your retirement, 1 to 2 years out from your planned retirement date, get an updated pension benefit statement from your employer, really finalize the savings and income worksheet to get a much better idea of what you're going to need in retirement, and again, finalize or complete that pension analysis and get it done. Again, a very important part of your retirement planning. So now I'd like to turn it back over to Forrest to summarize our presentation today.
Thanks so much, Laurent. As we mentioned, boomers are pretty ambitious about their retirement. After securing their own goals for their own retirement, they turn their attention to other goals, oftentimes relating to others. And this exercise requires the search for additional financial flexibility. These are some great ways to do that, adjusting your investment strategy so that it pivots and supports with your financial plan, adopting a fluid approach to spending, being thoughtful about Social Security, and finally, doing a careful analysis of your pension options. All of these are additional strategies that we've seen our boomer clients implement to really create more financial flexibility for themselves and their families.
Great. Well, thanks, Forrest. That's the end of the formal presentation today. We've left a few minutes for questions, so if you wish to submit a question, please type it in the questions box on your GoToMeeting control panel. We'll answer as many questions as we can. It looks like we have about a minute or two left. And if we don't happen to answer your specific question, we promise to get back to you with an answer after the presentation. All right, so it looks like there's one coming in on investment strategy, maybe for you, Forrest. Here's a question. I feel as if I'd like to change my investment strategy based on how well the market is doing, but I really know I shouldn't. How often is too often in terms of an investment strategy change, and when is it okay or all right to make a change from your perspective?
That is a good question, and as I said in this presentation, the best reason to change your investment strategy or adjust it really resides in your financial plan. So changing your investment strategy for emotional reasons generally has an adverse effect on overall performance. The reasons to do it should be strategic in nature, and so if your plan is changing radically over the course of a year or 2 or 3, it would make sense to change as often to make sure your investment strategy, again, continues to support and pivot with your plan. But I would discourage people from making emotional decisions about their investment strategy, either in a bear market because the losses are painful, which oftentimes means that people seek the comfort of cash, or looking at the stock market when it's performing really, really well and feeling like you're missing out and having that be the reason that you change your investment strategy.
Great, Forrest. Well, one question just came in on Social Security, but I think unfortunately we've run out of time today, so maybe we can get back to that individual via email. So you don't need to wait for our monthly webinar or letter to stay in touch. We've updated our website with new content regularly, and we post daily market updates on Twitter. Bonnie Bell has a blog focusing on career and life coaching issues, so you can find that at careerlifecoaching.bellinvest.com. And as always, if you have a question about your portfolio, please don't hesitate to contact one of us by email or phone. That concludes the formal presentation portion of today's webinar. A recorded version of today's webinar will be available on our website within about a week. Additionally, all of our past webinars are available on the website as well. Just a quick comment about the Quarterly Investment Committee webinar that's coming up at the end of the year here, or November. That is only available for clients. That is scheduled for Wednesday, November 20th. Again, investment committee updates for clients only. However, that will be followed in December with our year-end review and 2014 preview on December 4th. So that's the end of the presentation. Thank you very much.
Thank you.